Welcome back to the Deal Vault podcast. If you're a real estate investor looking to scale, secure funding, and learn from real deals, you're in the right place. I'm Greg, and together with Nate and Sarah, we'll sit down each week and break down market trends, funding strategies, real deal stories from our investors. Now, if you're ready to unlock knowledge, relationships, and capital you need, let's open the vault.
Well, welcome back to the Deal Vault podcast. I'm Nate, and this is Dylan. So Dylan and I are both team leaders here, and Greg and Sarah are out on vacation.
Vacationing. Greg's actually doing military stuff now.
Okay.
Navy stuff.
Yeah, Navy stuff. So he was by the water vacationing. Now he's on the water.
On the water.
Actually, probably not.
Definitely not.
But okay. Well, cool. Well, this week we're going to get a little bit tactical about, not in the military sense, but tactical in the sense that, like, these are very specific scenarios that we can run into from time to time, and it takes some strategic planning as far as what an investor should do when a property doesn't sell. And so oftentimes we will help an investor finance the acquisition and rehab of a property, or they did it with a local hard money lender, did it with their own cash, whatever. Their plan was a flip. And then, we're seeing this a lot with current market conditions, a lot more sellers in the market than we have buyers. Houses aren't moving as much or moving as quickly.
Absolutely.
And so that property sits on the market for a little while. I think everybody's got a different appetite for how long they can let that sit too. But whether it's 3 months or 6 months, we see, hey, I've owned this property for a while. It's seasoned. Typically loan seasoning or property seasoning isn't an issue on these scenarios. But maybe tell us a little bit, Dylan, about like what issue do we run into when a property has been listed for sale and then, oh, I've changed my mind. I'm not going to flip it. I'm going to BRRRR this property, hold it long term, refi, take my cash out, and go do another one.
Yeah. Biggest thing we run into, and happens every time. Like if you're going to flip a property, you want to get it sold as quickly as possible, right? So you're making those interest only payments. Typically, you're losing money each month. So what do? To move a property, you lower the price. Like that's always what happens. You're going to get it as competitive as you can for the market. If it still doesn't sell, a lot of times what you can run into with lenders is they can see those listed prices on the MLS.
For sure.
So what they're going to say is,
Or at least on Zillow.
at least
An underwriter's typically going to go,
they're going to go look.
they're going
and
to
say,
Google that property and see what is the Zillow history for this or something, whatever their listing website of choice is. That underwriter's going to at least do a quick Google.
It's easy to find. It takes you 2 seconds. So what they're going to do is they're going to go look and say, let's say, for example, the property comes back, we get an appraisal and it values at $250,000, but you had just listed it for $215,000. A lot of lenders are going to say, shoot, you were trying to sell this for $215,000. That's the value.
Sure.
Great job. Now that's not every option, but there are quite a few out there that you're going to run into. They'll use that for I think it's 6 months in some cases.
Yeah, it can be
Some options.
Yeah,
8 months.
It could be
months.
3, 6, or 12 months, depending on the lending team for sure.
Yeah.
We've seen that for those lending teams that specifically are going to cap you at the lesser of your lowest list price or the property value, then they typically have a seasoning period for that. Like, hey, we want it off the market for this period of time before we give you
The value,
just the appraised value. And
they'll do it.
Yeah, and I think conventional thinking would be that the property is never going to appraise higher than what it was last listed for or what its lowest list price was. I've had a slip of the tongue before telling people, well, the lender's going to go off with your last list price. And somebody goes, oh, well, I'll just bump the price up. And I said, sorry,
Your lowest.
I meant lowest list price. Typically, your last list price was also the lowest.
Yeah.
So you're not going to trick the lender by being like, oh, I dropped it down to 200, but let's just bump it back up to 350. Right, for a couple days, and then we'll be fine. No, they're going to see the full history of that price listing. But the appraiser, you would think that when you order an appraisal, they're going to see, okay, well, it didn't sell, and let's say in your example, it didn't sell for $215. So therefore it shouldn't value higher than $215. but there might actually be sales comps that support that. And so oftentimes our investors do think that their property is going to appraise higher than they've got it listed at currently. And I've actually seen that a handful of times. I know other folks in our office are like, oh no, I've never seen it come back higher than the list price. But I actually see that pretty frequently.
I've seen it often.
So like solving for the how do I just use the appraised value is actually something that does come up, because if your value always comes at or below what you had it listed at, then there's nothing to solve for there.
Sure.
But what we oftentimes do get asked to solve for is my value came back higher. My value came back at 250. However, my lowest list price was 215, and I've only had it off the market for 5 minutes or a week or a month. And oftentimes that's too short of a time for lending teams. So are there any scenarios that you can remember like recently where you were able to use the appraised value?
Yeah, we have some options that don't care about that. So typically if I've got some borrowers that are in that situation, let's say they have it listed today, it's usually how it goes. They come back and they say, hey, we've had this in the market for 3 months. We've dropped the price 10 grand each month. It's time to refi this. We got to get it stabilized. And so my first thought, having done this a little while, right, and knowing what we can run into, is typically I take it to our option that does not care about that. They go off the appraised value, that's it, which is a big perk. There have been times that it didn't fit with them in the past, and so I took it to one of our options and just kind of led the borrower up with, we might run into this issue. From there, we kind of dealt with it as, this is, in this particular deal I'm thinking of, it did value higher. I want to say they couldn't get a tenant in, and so we had to use an option that could do a fully vacant refinance.
Sure.
And so when the value came in, I don't remember the exact numbers, but the value came in higher than their last listed price. They already kind of knew if they were going to be capped at that. I told them, this is your value unless it comes in lower. Anything else above is just like icing for you. You have equity.
Yeah.
Right. But this is what you're going to get. And they were okay with that. So I just had to kind of lead it in with, this is your option. This is what you have. Unless we wait, they had just taken it off that week. And we would have had to wait, 3 months.
Sure.
They weren't, that kind of defeats the purpose of doing the refi. So
for sure. Well, because you still have those holding costs.
yes.
Now you just don't have your property listed for sale
At all.
now. Hopefully you get it rented quickly, right? But it can take some time to stabilize it.
Yeah.
I think a good clarifying point for the lending team that doesn't care is they're not going to strictly hold you to the lowest list price. They're still going to run a collateral desktop analysis.
Absolutely.
They're going to do these things. They're going to do these things that check the value in underwriting. But if that value that the appraiser gave, which is higher than the last or the lowest list price, see there it is again, the lowest list price, then they're good with that. Yeah. So they're just not going to have this line in the sand of, well, because it didn't sell for that, there's no way it could possibly value for that. Therefore, we're not going to lend based off of your appraisal. So you brought up another good point, though. Like, the solve is not always just, well, who can refinance this and just use my appraised value? It's also, is the property occupied? Because oftentimes we're talking to somebody for the first time. Usually when I run into these scenarios, it's not always a previous investor client who we did the rehab loan for. It's somebody who we ran into that is going to work with us for the first time, but needs a DSCR loan. And so then they're also learning that occupancy can be important.
Yeah. Well, especially in these types of deals, you're typically not just listing it. You don't finish the rehab in 3 months, list it for 1 month and go, I'm giving up, right? It's like you finished the rehab in 3 to 4 months, maybe, let's say, and you had it listed for 3 or 4 months. So you're potentially 8 months out on this and it's still vacant. You have no prospects for tenants. You may not even have it listed yet. Well, then occupancy becomes a big issue because you want to close in the next 30 days. You're likely not going to find a tenant in the next 30 days. And most lenders are going to want to see a tenant in the property if you've owned it for longer than 6 months. There are a few out there that we have that can do them vacant, but they're, far and few between.
Sure. Yeah. And a lot of times It can come down to, well, I've owned it greater than 6 months, so therefore it has to be occupied. But that's the lending team I want to use because they will give me just the appraised value.
Exactly.
Where
Try to mix and match these implications.
Exactly. And whereas if somebody, doesn't want to be capped at the last list price, but also doesn't have it occupied yet, and they've owned it between 6 and 12 months, lenders that can do this for you vacant and just use your market rents oftentimes are going to cap you at that. So it's certainly all about threading the needle, and that lending team that we like to utilize whenever we want to only use the appraised value, right? Or the fact that we had it listed for sale 5 minutes ago. They will give 90% of your market rent. So you get a haircut to your market rent on an exception basis, and that's something where if there's good mitigating factors like investor experience, strong credit score, liquidity, we've got cash on hand. I'm not only counting on this loan to refill my coffers necessarily.
Yeah.
Then that is. Those are all things that could contribute to an exception being granted, where it's like, okay, we'll underwrite to 90% of market rents as long as you're breaking even with this monthly payment based on that 90% number, you can have that loan. So, I mean, I think all that to say, like, there's a lot of solutions out there. It's just about threading the needle with the different implications we run into.
That's why it's good to use a broker like us, because we know all of those little
shameless plug.
Shameless plug.
I mean, it's tough.
It's true though.
It's tough to like go out and like find the loan product that fits things perfectly. So
yeah, well, I always tell my borrowers, it's going direct to lender can be amazing. There are amazing lenders out there, but they truly do have to try to fit your deal into their specific box. Whereas we can find your deal, look at your deal and say, where does it fit? We get to find, in a lot of cases, the perfect fit. No deal is perfect, but it does give an advantage to be able to do that. It can save some time and money for sure.
Yeah, most definitely. And the loan space, because it is, complicated, we actually invite conversations that may not end up with us doing a loan with you. Oftentimes I talk to folks about, hey, I'm planning on flipping this, but if I don't, or if it doesn't sell, what happens? That's a conversation that I have where then I get to actually bring these points up as far as, hey, if you don't sell it, here's where your credit is, here's where the value's at. Based on timeline and season that you've owned the property, here's where I think we can go. And it's just good to point those things out and prior to getting to that point. It's always tough to figure things out when the train's already moving.
Yeah.
So I think that's how it always feels whenever somebody hasn't sold a property and then wants to refinance it. It's like, well, the train's already moving a certain direction. Now we just got to make sure that we can make it work based on all the factors
we have now,
that we have right now. Whereas we might be able to, with some knowledge, established prior to the flip being done. If it's like, hey, worst case scenario, we got to pull our reserve chute and go to, a refinance. What are ways that I can like really, set myself up for success? And that's probably maybe having some tenants lined up,
ready to go. Yeah,
potentially.
Maybe towards the end, as you're listing it for sale, I've had a lot of clients that I have those conversations with, and they'll throw it up for rent as well. I had this recently, actually. He had it for sale for a month or two. The last month he had it listed for rent, kind of to see which one would get more traction.
Sure.
The rental got traction immediately. He said, all right, we're flipping it over. We'll take the cash flow.
Nice. That's awesome.
So it was just a great way to feel out, especially in this market. Like you said, there's a lot less buyers than sellers.
Yeah.
But there's still a lot of tenants. So if they wanted to flip it, didn't work out, now we're refining it.
Yeah, for sure. And then, I mean, if anybody ever wants to consider selling it again in a couple of years, like, hey, let's get through the Iran war. Let's let the market settle down a little bit. Get a happier news cycle rolling. Get some buyers back in there. I want to try to sell
to start, and then
so then we can lower the prepayment penalty, right?
Yep.
So, I mean, your best interest rate is always going to be with a 5-year prepay, but there's 3-year, 2-year, 1-year, and even no prepay options that typically just increase the interest rate, which if it's only over the course of a year or two, then not a huge deal. But you want to make sure that like, no, I'm definitely going to sell this. So otherwise, my recommendation still is always take the best interest rate you can today, and that's always with a 5-year prepay.
Absolutely.
Yeah. So
I agree.
cool, man. Well, like I said, just want to keep it kind of short and tactical today, talking about a very specific scenario that we actually see a lot of. And so hopefully that's helpful. Reach out to us if there's anything that you want to hear us talk about more, or just if you have questions about this exact scenario, more than happy to address that. So till next time, and when Greg and Sarah are back from vacation, we'll see you on the Deal Vault.
Thanks for listening to the Deal Vault. If you found value in today's episode, be sure to subscribe and share with another investor and leave us a review. If you're looking for help funding your next deal, you can always holler at us at loanbids.com. We'd love to help you on that deal. Until next time, keep building, keep investing.